bigger things happening inside the Rev community and RevThink I want you to know about. The first one is that we launched the next season of the RevThinking podcast. This season's about transitions. So I'm interviewing a series of people that have gone through transitions, sold their businesses, evolved, moved up the corporate ladder, that kind of stuff. And they're very honest about the transition season. There are ups and downs and pros and cons and highs and lows and all of that. I want you to hear what it's like to go through those transitions. So as you plan those yourself, you know how to be proactive about some of the issues, but also just realistic of what it takes and the hard work it takes in some cases that we aren't even aware of yet. So using other people's examples. So that's the RevThinking podcast. We also started a partnership with Stash Magazine. So if you're a member of Rev Community, Stash is going to be providing us on a weekly basis a feed from their media, Stash Media website, as just inspiration. It's not often we get to see creative people from around the world, and that's where Stash differentiates themselves from other magazines and media companies. They're finding creative talent all over the world, and they have a level of discernment, not just based on the production quality and the creative quality, but the emotional quality too. And their team does a really great job for almost 20 years, 22 years, something like that. They've been doing this. So they have quite the body of work. And so in Rev Community, there's a channel called Inspiration by Stash, and we're going to just watch that grow. But Stephen, the owner of Stash, and I have been working on this for a while, and we just launched that together.
Stash is the OG.
It is the OG.
Stash. And they just haven't stopped.
Who used to get the DVDs from Stash back in the day? Right?
Yeah. I had so many DVDs.
Yeah. And it's still going. Okay, so one more quick thing. Lady Bosses, there is a retreat coming up April 26th in Los Angeles. We have the Sunset Marquee Hotel for the day. Shauna Schultz, she's here smiling today because she is coordinating that for us. So if you're a lady boss, want to be part of the retreat, the price right now is $450 for the day. It will go up to $550 as we get closer to the event time. We want it to be accessible to everyone. So if there's any questions or hardships or whatever that would get you here, please reach out to us and tell us. We have some amazing speakers for the day, but it is also kind of a retreat. So Shauna is reminding me I can't just like find a whole bunch of, 8 straight hours of people talking. Like there's going to be some great retreat moments and these things called nooks where you can do some breakaway, talk to a mentor woman, a mentor person walking you through certain aspects of life or business or career, those elements. So we're going to kind of program it so there's a lot of opportunities available to you. I just want you to know those are coming up behind the scenes of what we're doing, and they're available on community, but just want to point those out to you. All right, so that's my commercial for the moment. Anything else I need to jump into? Who wants to hear about this topic?
Me.
Here we go. Here's the reality of what it means to be a Rev thinker, right? So we're working with production companies all around the world, different industries, different sizes, different people groups, what have you. And I was pointing this out in the small group discussion this morning. It's odd when all things are in sync across the world and across segments of our industry. So live action and post and graphics and entertainment and commercial and film and all these aspects, but there's these weird global things happening that everyone's feeling these ups and downs. It's probably just hangover from COVID, but it's a reality of what's happening. And I want to point out to you so that we're all on the same page and all we can relate to. But clearly I'm talking about economic issues that are related to the industry, as well as technology issues that are coming up and the ability to adapt to and grow and be smart and strategic about the technology. And one of the things we get to see at RevThink, because we're seeing this big bunch of data, is we can analyze things. You might be wondering what it's like. We can tell you more clearly, like, yeah, that's what's happening. And I'm mostly concerned about some things that are not often true globally. And one of them is this topic today, this cash cliff that everyone is probably feeling. I want to explain to you what the cash cliff is and then explain to you what to do about it. It's going to be really obvious if you have a cash flow sheet to see this.
And you're seeing some cliffs, Tim.
We're seeing the cliffs for sure.
Yeah.
The cliff is happening. So before I go too far, I just want to explain cash flow. Many of you know what this is, but just as a 3-minute, elementary kind of version of how cash flow works and what I mean by cash flow, because the cash cliff is inside of the cash flow world, right? On a week-by-week basis, you have elements that are coming in and out of your checking account, and that's your cash balance. You often just start with a cash balance. You might have received payments that week. So those would be cash receipts. And that would give you amount of money you can spend in that week or what's available, cash available. And in that same week, you have to spend money, sometimes on staff, sometimes on outside expenses, accounts payable. And then there's these like global or company expenses. So creative expenses means those things related to the project, company expenses, overhead items. If you had cash available this week of 200 and you have expenses of 125, what will be remaining at the end of this week is $75. That's very simple, right? If I took this $75 and I moved it up here to this next week, and by the way, what I've already done, I don't want you guys to think I'm typing really fast. I actually have projected out what my expenses are on a week by week basis for the next 8 weeks. So I know what my staff is. These are payroll, repeat every other week. But I also have like accounts payable, like bills that are due or will come in eventually and will be due. Because if I hired somebody today, they're going to invoice me in 2 weeks and then I'm going to pay them net 30. I still know what that amount is. So I can project out what those expenses are into the future. I could also look at company expenses. These are more on routine. You'll see, like, for example, this 4 weeks match these 4 weeks because they're often like rent, insurances, and so on that are somewhat static and they just are repeat. So I can take my expense items and program that out first. I can also look at my company's accounts receivable and get a sense of when that money is going to come into our checking account. To be clear, this is not the due date. This would be the date they would actually give us the money. Because you know what I mean when clients don't pay us when they're supposed to. So I actually want to be realistic of when it's going to come into the checking account. And I could put that out here on a week by week basis. So this is a very elementary look at it, but I just want you to know I've already kind of done that work. So now if I have week 2 on my cash flow, those cash receipts would come in automatically. Those expenses come in automatically. And I can take this formula that I have on these items, summarizing my total cash and my total expenses, and even just the remaining amount, I can copy these out 8 weeks ahead. And look, I took the $75 remaining here. It starts next week. And then next week, I'm going to have $50 added to the account because I'm going to get some money in from my clients. So I'll have $125 available. In that week, I have $74 in expenses. So I have $51 available. And I can do that week after week after week. So week 3, same formula, week 4, 5, 6, like that. So that's what cash flow is. It's looking at when the money would leave our account, when the money would come into our account, and then knowing what this remaining balance is on a week by week basis. So that's my goal in cash flow, is to look out as far as possible, maybe 6 weeks, 7 weeks, 8 weeks into the future. Some people, it's appropriate to do 12 weeks. Eventually, you will run out of money. You'll see a negative. And that's what we want to know. Cash flow is not a money report. It's a time report. How soon until I need to do something different to make up for the gap? If I have 7 weeks when I'm running out of money, it tells me that I have 7 weeks to bring in a new project, increase this revenue that's coming in, right? The cash receipts would then come in, and then I would solve this burn rate problem, this expense problem, by bringing in new revenue and filling in the gap. So that's what cash flow is. It's looking at the cash coming in, cash coming out, and the time available to do things proactively to solve problems before they become real problems. That's the purpose. And that's how I use cash flow with my clients, and many of you that have done cash flow with me know that already. So I point that out because I'm going to show you a more complicated system, but it has similar traits to it. This is a cash flow system that we build out for our clients. It looks more complicated, but the elements are the same, right? Beginning cash. These are the expenses, but these expenses are more detailed. It allows me to help make decisions with my clients on a week by week basis, but I get a total of expenses down here. I get a cash remaining. I also get cash receipts, the AR that's going to come in this week. In this case, I'll turn off. This one has a sales project I could turn on and off, but I can add any new manual items or because they're like a project item that's coming in that I know I'm going to get hit from. And then these are more automated, coming from my QuickBooks system. So an item that's going to come in, not yet in QuickBooks, I can actually override it here. But it's still the same. It's just starting balance minus expenses, adding in accounts receivable, and so on. And my cash flow, I can look at it on a week by week basis or look into the future till I eventually run out of money. And then I can understand like, well, what if we added this new project? Oh, sure. Let's add that into our cash flow. Oh, look, it just bought us more time. We don't run out of money if we get that project in-house. What if we don't get in-house? Okay, well, what else do we know is coming up that if we receive that money or worked on projects, we can grow that way? And often my cash flow meetings with my clients are exactly that, running through these scenarios. What if we win this bid? What if we don't win this bid? What if we add this person? What if we subtracted a person? What if we added a new person to our payroll? We can just look at the scenarios and understand how it affects us on a cash basis. So that's the purpose of it. I'm going to show you what this person's cash flow looked like in January so you can see what I want to focus on today. This down here is their accounts receivable. Now, this is a fake company, by the way. I don't want you to think I took someone's stuff. These are not real. I use ChatGPT to fill in these vendors and give me numbers. So I ran a scenario to give me the variables in here. So, but this represents what my client's cash flow looks like. You can see here, and then in this time period, this 6 to 8 week time period, there's accounts receivable. And then over here, there's long-term accounts receivable. Sometimes it's the second 50% payment, or like this would just project as a third, and a third. Sometimes it's the 50-50 elements of what's going on. And you can see how this stuff fills in cash flow. An awarded project creates 2 invoices, sometimes 3. First 50%, second 50%. And I put them both on here. First 50%, second 50%. So I know that the long-term AR will eventually have an impact on my bottom line. But here's the reality of how cash works, not how the splits work or how your budget works, not in that category. Cash is that we usually get the first payment sooner in order to match the outgoing expenses on that project. So that first 50% payment being paid net 30 to the award matches the first 30 days of, or possibly 60 days of work you're going to do on that project. Therefore, when the AP comes in, when those freelance costs come in, or as you make payroll during that same period, that first money comes in and it covers the costs related to a project. That's why the client gives you that money up front. They want to guarantee you're going to be in business and finish this project. So they give you that first money so that that project is financed through completion by giving you that money up front. The second 50%, I'll say like, for this purpose, I'll say like it goes to the house. So the second 50% is what the company costs come out of, not the creative costs, but the company costs. It's usually what finances our long-term AR second payments, finance those services, because there's no longer a need to hit the cash hit because the freelancers are paid off with the first 50. So we need to keep this money around. So that's the long-term AR. And you can see this company is very balanced that way. Short-term and long-term. This is January of 2024. This is March of 2024. This is what happened. The short-term AR was collected and spent. The long-term AR is coming due, and there are no new projects. There have been no new projects for the last 60 days. So I'm using what was long-term AR for the short-term right now. And there is no long-term AR. There's a cash cliff happening. So a new project awarded has a hiccup in the system. So even if you were to get a new project today, let's put one here. Let's say a project was awarded today and the first 50% was paid. It's a $400,000 project. So we'll turn this scenario into $300,000 in accounts receivable. We'll make it extreme. That payment comes in right here, 300. And you might be thinking, doesn't that cover all the problems, Tim? No, it doesn't, because this $300,000 nets out to be somewhere near zero. So right here, do you see where I have net reduction of production from sales? So this line item right here is what I'd say like, well, of the 300 that came in that week, I'm going to spend all but 20,000 of it. I don't know, 40,000 of it. So I'm actually going to add an expense item of $260,000 to match that long-term AR. So even though we're so excited that this big number AR is going to come in, when it nets out, because I have to project my expenses against that AR, there's actually no money left. And I don't have long-term AR to fill in that gap, right? So I need to start be thinking about this operationally and systematically. We have to start building up these reserves in a new way, because eventually you will catch up. It will, that second 50% payment, let's say it came in here, this $300,000 came in. I don't need to net out that amount. So this second one fills in the gap great. But these are really bad days, right? And depending on how long that cash cliff is, how long that gap is you have, that's how many days you have to get through and survive to get the second AR in and keep things going. That's the cash cliff. That's what I wanted to point out. But I just want to give you a couple of quick items of what to do about this. So not so easy, but more obvious is when we get these payments in from our client. Let's say I had a $300,000 or $600,000 project. I would have rather had 150,000 4 times every other week, because then I have access to $450,000 in this same timeline. Then I had access to 300 and then 300 more. And when it's all said and done, I get all 600,000, but I'm getting things in sooner. So one way to think about this is that you could be creative on the payment plan that the clients pay you during that timeline. And you can start filling in this gap. So sure, you can, why not say, Tim, let's make it 50, 25, 25. Yeah, go for it. If you can get that instead, get this 300 and then get 150 sooner, let's say upon completion of an edit or completion of approval of something. And then the next one, maybe this last one is one of those horrible net 60 payments, who knows? But at least I have access to 450 of the project money instead of just 300 and then waiting for that long-term AR. That's one thing we can do. We obviously need to start stacking in new sales. And the new sales, we might want to go after bite-sized pieces. I know this looks like a big chunk of money for us, right? I'll take this money out so we can see how bad it was. 380,000. But at least maybe I can dive into this thing and solving this problem in smaller pieces. So a few $50,000 projects, and I'm just plugging in here so you can see that it's impacting. A few $50,000 projects adds up to something and start solving the problem. So we can start biting into that way. If I added that plus these new net terms of a third, and third, I can start seeing, hey, this is not insurmountable. Negative 31,000, negative 90,000 was hard. Negative 31,000, I could probably do something about that. I might be able to do something about it up here in these accounts payable items, or list, what my terms are leaving the company can also be arranged. People would hate this. Don't tell your freelancers I'm telling you to do this stuff, but you pay people net 60 instead of net 30, right? So what you net out is also stretched out. So you're getting the companies, the client's money in sooner to pivot out further. So this isn't 260, it's actually 120. And I'm making these payments slower over the same period of time. And now what I did is I just moved the problem, which was right here in these weeks, back another 3 or 4 weeks. So I just bought myself more time to fill in the gap with more work and so on. Because what I want to do is buy myself time to solve that problem, especially as it feels like things are picking up in Q2. A lot of us are recognizing that it's going to come in, but this hiccup's going to be really, really painful when you have projects in house, people that need to be paid, the projects are working on, and you don't have cash on hand because the client on the current project isn't giving you the money, and you already spent the projects from the long-term AR that you earned in the past in the short term. Sometimes I wonder if this all makes sense when I explain it, because it's clear in my head, but it's not always clear when I explain it. So I want to make sure I give a chance to answer any questions. But that's the big picture. That's the cash cliff that I see, and I wanted that warning to be out there and give you some proactive items to work around it.
Apart from no long-term sales, are there any early red flags you can watch out for, Tim? And I also noticed there's a few less people this week. This week's a bit like coming to the dentist rather than going to a inspiration session. So well done, everyone, for turning up. Because,
I know.
It can be a bit harsh thinking about this stuff.
Right. If I talked about sales, everyone would show up, right? Because this is the more realistic point of view. So early signs of this. Well, I would just say we already know the early signs of this. It's it's slow sales. But we don't often recognize the impact of slow sales. We often think of it as like, I just need money in house. I just need money in house, right? Because it's 20 days from now, 30 days from now is when we need to fill in that gap. And we compromise in that timeline. We go for easy projects, cheap money, faster turnarounds, whatever to fill in that gap. I totally know that's a smart and good reaction. But one of the things I feel like when we compromise is we compromise on, we're just so happy to be awarded this project. We forgot to push back on something that's really important, like getting our money in house. So even though you might feel like I really need this project, well, what you really need is the cash part of it. So you don't have to push hard, but you need to be aware of like, wait, this is a season. I need to use different words and to use some different negotiation tactics to get that money in house. Many of you might have a line of credit that you go like, well, Tim, I'm not too worried about it. I'll use my line of credit. The whiplash of that is that you basically just covered up the problem using your line of credit. And if it doesn't correct itself, you have a cash cliff and you have debt. So I really, really caution people on this moment to use credit to cover operating expenses, because that money is burned and never to be seen again. And if you're hoping that a new project's going to cover it up, don't put your faith and hope in that one. This is not the time to do it. If you know for certain that someone owes you money and it's coming 14 days and you need to cover a gap for 14 days from your line of credit, perfect use of the line of credit. It's a great use of it, right? I get the first award. It's a $600,000 project. I'm going to use these extreme numbers just because I was using it on that example, but I get a $600,000 project. But I get the idea of like, oh, I can get the payment in sooner than later, 21 days or 28 days. Okay, awesome. I know that I have a few payments related to the project that was just awarded that has to go out the door. You can cover it for that one. But if you're covering last week's AP with your line of credit, hoping that the new project's going to fill in that line of credit, I would use a lot of caution there, because it's going to take you a lot longer to get out of that line, that credit line.
We've got a question here from Phil. Why are the receivables categorized by projects, but the expenses are categorized by types?
Yeah, that's really good. They're actually already sorted by project on the production rollup. So when I build out a system for a client, I'm pulling data from the production rollup, which we already had the production meeting where we're looking at project expenses over there and if we're on track there. Here, I'm just trying to get really clear visibility. And I tell my client, because of what we saw in production, here's the impact on it. So if I needed to change something, I might go to the production roll up to change it. It's just how I work my routines with my clients. I feel like there are different people making different decisions on different days. So my finance meeting is me, the owner, maybe their bookkeeper, like the finance team. The production meetings, your producers, your art directors, and so on. I don't want them to worry about cash flow. So I'd just stick with production operations and production finances in one category, same data, scramble it a little bit differently and look at it on a cash flow basis for the finance meeting. Just gets different decisions and different people making those decisions.
I can just add one thing to that. It's also that projects, when you forecast accounts receivable by project, that is because you're getting a certain chunk of money from a client, and that money might arrive at different times based on when the project kicks off. Whereas freelancers or expenses, they happen weekly, whether or not your client pays you or not, most generally. So that's one of the reasons that drives the template into that kind of format.
Yeah, thanks for picking that up, Jay. I didn't say the second part, which is, your delivery of the project is what the AR is dependent on. So the impact of that delivery, and you want to see the impact of that delivery on your cash flow. Yeah, that's exactly right.
Question from Shauna here. How long do you wait with an upcoming cash cliff before you make big choices to cut expenses, especially if the trend has been slow sales for the last 6 months? Are there any indications that you feel like things are going to turn around at all for Q2 and sales will increase for marketing videos? About 3 questions in there, but it's all the one question.
That's good. I can hear the overall concern. So let's just say like Q2, you can all take a vote. We can run a poll right now if you want to, but it feels like Q2 is picking up. There's a weird moment in this Q2. I don't know if you're all feeling this, but where people are getting opportunities for projects, but their win rate is less than it usually is. So if my win rate is usually 50%, people are getting pitches, right? It feels good, but their win rate's like 25%. So it almost makes you feel like the clients are shopping wider. They're looking for, there's more people in the pitch process, or they're like, I don't mean this to be as derogatory as it's going to sound, but like they're like fake pitches. They're kind of just like wondering if they should do a project. So they're out there like asking people, would you pitch? Would you pitch? Because they might be selling it up the food chain to turn it into a real project, and it's not yet really award ready for you. So that's I'm just curious because that's a little thing I'm seeing. But the fact that it's picking up means that they understand projects are going to come through, and so far Q2 seems strong. That's why I want you to get through this cliff so that when it picks up Q2, Q3, we're ready for it. How long should you wait? So you have to match your expenses to your revenue. And we often think opposite. We say, my expenses are static. I need to go find revenue to match my expenses. That's how we go about the sales process. And often we can hit that, right? That's making your future. I'm going to project out my future, project out by will, keep my team going, and then I'm going to do the hard work of winning those projects. So I'm going to put in the elbow grease myself to win those projects. It's just when the sales actually aren't coming in, we have to tell ourselves the truth. To be honest, expenses have to match revenue. So if I'm looking at a cliff, I want some flexibility in my expenses. And this is really bad news, but this is how it plays out, right? Your burn rate is in your staff and your overhead. That's where it is, because you have to pay payroll every other week, regardless if projects are in-house or not. For freelance, has a dynamic nature. I only bring you on when I need you, and then I pay you as I need you. What we hate about that is that if everything's in the freelance category, there's no retained knowledge in your business. Your production method goes away, your magic, your secret sauce goes away. And we have to rebuild or put more of that burden on your shoulders to be the glue that holds freelancers together. So it's not the greatest immediate reaction, but you do have to kind of think through like that dynamic nature of freelance or independent contractor opposed to staff, and create that dynamic nature is sometimes what we have to do. So always, as you're thinking through that process, number one, call me, because I'll cry with you, and it's a free call. Nobody has to pay me to do that call. I'm happy to do half-hour calls. I'll say this again. I have to do half-hour calls with every single person here and talk through this if it's a reality, because we have to deal with it. But I want to systematically and strategically walk through who the person is, what their value is, what role they have, how long they would have to be off. Some people, we just say, hey, forced vacations. I owe you vacation time. You must take vacation time now. That would solve a problem, because it's an expense you're going to have on the back end if you lay the person off. But it's also like, why not? We're slow, go do it. And it's one less debt I have is your vacation time on exit. Other people, they'd be willing to cut back their hours, cut back their pay. I've had companies where they gave everyone a 20% decrease for a while, and the company was happy to do it and maintain their job at 80%. So there's a lot of creative ways to work through it, but we're going to have to deal with the reality of like right sizing the expenses to the revenue for this season. And then knowing when the season picks back up, we didn't ruin everything. It wasn't just getting rid of everyone and trashing everything. We can bring them back on and build the team back up with that retained knowledge. So that's what we want to do, is be very smart, strategic, personal, relevant when we make those decisions. By the way, I could talk about this all day, so I'll keep on talking. I know it's past our hour, but and I'm happy to keep answering questions. I just have a small group starting in a half hour, but I get this, and I want to make sure it's out and everyone whose questions are answered. So I'm happy to keep on going.
Yeah, we should probably look at selling creatively some session too soon, Tim. Like just some different what to try, what's different, some different tactics. That'd be good.
One of the things I'm considering, and few of you have gone through this with us, which is Revolve, which is the accelerate we did every once in a while when there's a big major shift, and just to like deal with the shift that's happening. So I've been thinking about putting together another Revolve and talking about the dynamic nature of today, this time, and what we need to change, what the revolution looks like that we would need to absorb and bring into our company, and just right size our thinking to the dynamics of an economy that's putting a crush on us and a technology that's evolving because of the crush, right? I'm going to use more AI today because I need to do things on the cheap in my company. Therefore, I'm actually making AI more legitimate. And the economy is forcing us into that. So there's going to be like a really interesting evolution coming out of this revolution. And we need to kind of absorb that. So to your point, Matt, I've been thinking about Revolve. If you guys have an opinion about that, give me a high five in community or something if you want to do it. But it definitely seems like one of those moments we should talk about it again.
Yeah. Thanks everyone coming. And this is definitely, a gritty, realistic topic, and but one that you've got to face head on. And if you don't have a cash flow, you should get one.
Yeah, Phil, you're pointing out a really great thing. It's like, what's the real work of sales in this process? And how do we actually measure those sales? Here's what we're going to, in this moment, we have to really depend on the likelihood of getting those sales. So there's a lot more diligence and due diligence in the sales process before we're going to bank on that win. Is get a sense of like, wow, how much can I trust it? I personally don't like to bank on sales. It's a luxury to be able to do it. But right now we're beyond those luxuries and we have to start banking on sales. So qualifying our clients is one thing we talked about in sales keeping. How do we qualify the clients? How do we qualify the leads? And how do we qualify the work? Is it something that we do and do easy? Is it a client that's dependable and always comes to us? And is it a project that's worth our while at this time? This is like those three qualifiers are something we should be considering. It's not real relationship reward, the 3 R's. These are like how legitimate that lead is. So that qualifier part of it is a big part of it. And it might be part of your strategic growth of your team too. Which team members you keep on and which team members you let go of. In a downside, the sales keeping tools and sales keeping system of qualifying might give you some information on who to keep, like who's leverageable right now to keep the projects in house.
It's also good when sales becomes a team sport. Like I think one of the good things about sales keeping is you can set up accountability within your own company rather than everyone staring at one person going, why are we dying? Sales is a multi-headed beast and it needs people hitting it from different angles, needs different approaches. It might be talking to the creative director, it might be talking to the EP, it might be talking to the head of production. You don't know, and different people in a studio have different relationships. So working those different angles together is really important.
Matt, and that's perfect. You're really good at that. You're really good at like teaching the team the tactics, being able to get producers on LinkedIn to say something different than the creative director or the PR person pushing something. This relationship stirring that the whole team can do and get feedback and knowledge from your team is something really great. You don't have to, I know we all feel this way, but we don't have to put all of the burden on our own shoulders. Your team loves you. They want to keep on working with you. They're actually curious how this works anyway. So to put some routine and mechanism in place and encourage them and get some feedback is really great. And Matt, you are really great at that when you put those teams in place for people.
It's way better than just clamming up and freaking out, because that's the worst thing you can do apart from just staring at a cliff.
Right. Yeah. I know it's like a weird moment of confidence, isn't it? It's almost like why I hate to bring up these topics, because I feel like everyone's like, oh, and gloom and doom. And I'm not. I'm trying to be proactive on this. But just like the reality of business is what we're up against. So how do we keep our businesses moving forward is always something we should be encouraged to learn. Yeah.
As David Lee Roth says, if you're not moving forwards, you're moving backwards. And, David Lee Roth was leaping forwards. He was a man in motion.
This is what we're doing. We're bringing in Van Halen philosophy in our topics. This is awesome.
Van Halen he was a great contract writer. Like his Brown M&M contract was world famous.
I love it. All right. If you guys have any more questions or thoughts, again, the half-hour meetings are very easy for me to fill in. Just hit me up, tim@revthink.com. Just write me an email. Erich will get the email. She can put you on my schedule, and I can do these all day long. So I would love to look at your cash flow. If you don't have a cash flow and you want to get something up and running, we can spend a half hour building that for you as well. I just have you bring a couple reports to the meeting and we can do it. I'm available for that. Jason's available for that. But just to get a sense of what you have and what's available. Each company is different. There's different elements and reasons to customize that decision. That's why I don't just give a global answer for everything that's going on. I want to know specifically where you're going, what you have, and what the opportunities are for you before we make that decision kind of globally. But I want to be available to you that way. You can also just be available for each other. That's what the community is for. Post information. Someone asked about the slow Q1. I thought it was great conversation. A lot of people just giving some truthful answers and getting understanding of how the whole industry is moving right now and making some smart decisions that way. So use each other, reach out. That's what community is for, is those community boards as well as the DMs. And then if you're a lady, you need a retreat. So come April 26th to the Sunset Marquee and take a break from this. $400. Come on, we can figure that out. Yeah. But you also need to take a break. Give some time to yourself. And give your chest a moment to just think about things and rejuvenate, rekindle some of that energy that you have inside of you.
And there's Camp MoGraph in Australia in June if you want to take a really big break. I don't know how far your concept of breaks go.
Matt is trying to get us all to Australia. All right. Yeah, right.
Courtney's with me. Yeah.
Yep. Coming over from Melbourne.
Oh yeah, I'm game, Courtney. Sign me up. Well, I'll just say this. I think you guys know this, but I love you and I appreciate you. I know this is always the greatest moments, but we can do this together and we're stronger together. So when we say we exist so you can thrive in business, life, and career, it's all the elements that are part of it. So be sure to include us in your journey and whatever you have going on, if you have any questions. And thanks for being part of today's weekly briefing. It's great to have you. Next week, I have one more financial piece I want to share with you. So as a 3-part series, next week's one more piece that I want to show you how sales snaps into some of this. And I want to give you some perspective of what that looks like. We've been working really hard in the small groups, trying to get a sense of like where sales are going and how to put the pieces together. And I want to take some of what we've learned and what we're processing and see if we can't put out to a global thinking of maybe where your business should be going or some possible directions and visions you have for services you're offering.
I'll be here.
More fun next week.
Oh yeah.
No, you will be.
All right.
All right. Thanks everyone.
See you
have
guys.
a great week and feel free to reach out. Talk to you soon.